Hello, everybody. Happy Wednesday. Hump day for many here. And I think I'm working. I hope so. Otherwise, I'll find out in a second. But actually, let me check the audio. Testing 1, 2, 3. Yes, we are in business. Sorry. Always have to check that. So today is an interesting story, and it's been inspired by many people, many conversations. And this was triggered by a conversation with Jeff Hammer in the community. It was also triggered by Tom Lee from Fundstrat. And this is about a theory I've known about for a long time, but I wanted to dig into it. And really, I regret not doing it in early 2022. And I'll tell you why. Because we'll see. It's all data. But I analyzed nearly 75 years of data to dig into what actually happens and if the first 5 days of the stock market performance are an indicator for what will happen in the rest of the year. And again, this is the kind of the story blowing it up here in a big book. Some analysts pay attention to this, the first five trading day performance. Can it be a good indicator of a good year or a bad year? And I wanted to dig into all of that and get the answer for myself, because some people think yes. Some people swear blind by it. Some people think it's a myth or an old wives' tale. Some people think it's a great omen. So let's dig in. And of course, the first 5 days in January typically are the coldest of the year. So hope everybody is out there has good heating on or warm clothing, etc. And let's find out if this is statistically significant or if it's BS. Now, CNBC did say the other day, I think it was January 7th, think it's a very good omen for 2023 and it's poised to send the stock markets to go up. Now, I hear all the crypto people groan, oh, stock markets, we don't care about stock markets. But yes, you do, because stock markets and Bitcoin and other cryptos are correlated very heavily with the equity markets. And you can see here, I drew a little red line in this chart to show you the correlation. Of course, there are some outliers, but 80% of the time, crypto follows the stock market. So therefore, you need to know where the traditional markets are going if you want to play in this game. If not, then it doesn't matter. So let's analyze. What I did was I took 74 years of data, the opening price of the S&P 500 at the first trading day of the year, and then the fifth trading day of the year, the closing price, calculated the delta in between, and it was a heavy lift. And then I also calculated the opening price on the first trading day of the year compared to the closing price at the very end trading day of the year. And the chart looks like this, a whole bunch of spaghetti. So the red is the right axis, which is the performance over the first 5 days. And the blue is the left axis. So this really doesn't tell you anything apart from things go up and down, but it does look a little bit correlated. But let's map them out. This is 73 years of data plotted. I have 74 years of data for the first 5 days, but not for the stock market return because we don't know where it's going to go. But what you can see here, according to this plot, is only, if you imagine the big cross in the middle is the 0 point across these axes, left axis is the annual return for the S&P 500. The bottom axis is the first 5 day return. And you can see a couple of things. Let's blow this up a little bit. First of all, when the first 5 days of January are positive, over the last 73 years, we only had 6 negative days. Okay, that's one part. And then if we look at if the first 5 days is negative, we only had 10 negative market days. That'll all make sense a little bit better, but you can see the majority of the returns are up and to the right, and that is what's important. So let's jump a little further ahead. Let's analyze just the first 5 day history over the last 74 years. The average return is 0.3%. Okay, let's look at that carefully for a second. You can see the min max, the worst performer opening was minus 5.7%. The best was nearly 7%. But here, the 5 day period and 252 trading days in a year, if you annualize that, it'll give you about a 25.2% return. Now, I do not expect a 25.2% return in 2023, but I do expect something. Let's get more into the numbers. So if the 5 day return is greater than 0, Only 6 times in 73 years was the stock market return negative, or 8% of the time. And the average return of the stock market is 16.1%. You can see here that 16.1% beats the 12.5% we just spoke about as being the average. And that's just if the first 5 days is positive. Now, what happens if the first 5 days had over 1% return? And this is exactly what has happened this January 2023. We had a greater than 1% return. So I looked at that data to see if I could pull out any patterns. And you can see when it is greater than 1% return in the first 5 days, the average return is 18.1%. Better than 12.5% and better than the 16%. And we only had 4 negative years in the 73 years, which you could argue is a 95% win rate. But of course, the past does not predict the future, but sometimes maybe it rhymes. And again, that's where we are, and they are all the years. Now, if we look at the negative numbers, if the 5-day return in January is less than 0, i.e. negative, only 10 times in 73 years was the stock market return negative, but the average return is only 6%, not 12.5%, not 16%, and not 18%, which, again, is interesting. Also, if you look at, actually zooming into this again, if you look at 2022, you can see here the first 5 days of 2022 had a negative 2.11%. And that should have triggered our alarm bells. And that's why anytime, well, you see in the conclusion, one of the things, but it worked freaking well in 2022 because the stock market sucked. In 2022, S&P 500 down 16.95%. Let's go a little bit further. For those that argue, well, S&P 500, how does that compare to Dow Jones? Well, the Dow Jones chart reports the odds kind of similarly. And this goes back to 1896, went even further because I could pull up this summary. I didn't have to crunch it all myself. But the Dow has risen in 67% of the calendar years since then. Remember, the early first 50 years of the stock market was very bumpy, half up, half down, very nasty times. But if we assume the future is the past, there's a 2 out of 3 chance it will rise this year too. Now, if we just focus on those years in which the market rose over the first 5 days, you can see 68% were gainers. When the Dow Jones rises over the first 5 trading days, it's 70%. When the Dow Jones gained more than 1.5% over the first 5 trading days, like this year, the return is 75%. It goes up 75% of the time. And when Dow Jones rises in January, 72% of the time. So it is not, you could argue, statistically significant, but it does tell an interesting story. But remember, the Dow Jones is only 30 companies. S&P 500 is 500. And my philosophy is to excise the winners when you can. So another trigger for this was kind of a conversation going back and forth with some people. And this was something I posted and I've been talking about for a long time. So being on the train for the best days. So for example, if you missed the 10 best days of the stock market over the past 30 years, your returns would be cut in half. If you missed the 20 best days, your returns would be 73% less. And if you missed the best 30 days, your return would be 83% less. And missing the best 30 days, of course, is astonishing. Now, the question that came up from the community was, what would happen if you were out of the market for the worst days? And of course, it's very, very difficult to time the best days and the worst days. But this is the analysis that I did of the top 20 best and worst S&P 500 days. First of all, what's interesting is all the best and worst days happened before 1940 or after 1985, 1990 timeframe. Very interesting. And digging into this, you can see they're kind of like evenly dispersed. Sometimes, early 80s was bad. It's funny, the 70s was a horrible period, but didn't have any volatile days. It was just crap for a long period of time. But let's analyze these performers. So on the left-hand side here, you see the best 20 days averaged a return of 9.86%. The worst of the top 20 days was 7.5% in one day, and the best was 16.6%. Now, comparing that to the worst days, the worst was 9.5%. Not as bad, actually, not as deep as the best day. And of course, the minimum was minus 20%, a nasty day. And, that's just some history there. So the point is, It's very, very, very difficult to time the worst days and the best days. And if you could, you would be a master. So here's the conclusion of all of this data crunched for you. So if you imagine the three categories, again, to summarize, we have the 5-day return of January being less than zero. The average gains in the stock market are only 6%, and the market is down 14% of the time, up 86% of the time. And that's going back 73 years of data. If the 5-day is greater than zero, the average gains in the stock market is 16.1%. And the up market top percentage is 92%, down 8%. Half of the amount it's down compared to the 5-day return being less than zero. And compared to 2023, where we are right now, the 5-day was greater than 1%. And historically, the average gain is 18.1%, and the market is up 95% of the time. So here we are. According to this and history, considering what we've had in the first 5 days, if it repeats, there's a 95% chance the market will be up and the average returns are quite healthy. So the question is it a good omen? Does it look bullish? Well, yes, if based on history. But remember, there are factors like inflation, interest rates, geopolitical turmoil, supply chains, slowing economy. All that stuff is in play. But history also says that the market bounces back before the market even realizes it's in a recession. And that's another important thing to know. But remember, all eyes on this for tomorrow. This is JP Morgan CPI game plan. And I covered this, I think it was on Tuesday. But if we get a reading of inflation of 6.6% or higher, the market could fall 2.5% to 3%. And there's only a 15% chance of that. But the expectation is for 6.5%. Now, they play with the numbers here a little bit, JP Morgan, because they say 6.4 to 6.6, but they cover 6.6 and the above. But anyhow, they believe there's a 65% odds of that happening, but they're kind of double counting. But anyway, I'm sure they're smarter than me over there, so we'll see. Anyway, if we do get 6.4 to 6.6, it's 1.5% to 2% return, and 6.4% or lower, they believe there's a 20% chance of happening, and that would be 3 to 3.5% as we go forward. So that is where we are. The history, the numbers are fascinating in my opinion. I hope you enjoyed them. Hit the like if you do, and let me know as well what you think will happen. Back-to-back negative years is also extremely rare. Do you believe the market will go up or down? Well, let me know in the comments below. And thank you all for being here. Happy Wednesday. Bye all.